In my last video, I discussed primarily the inflation impacts from the Iranian war, emphasizing that the inflation impacts go far beyond the spikes in gasoline prices. Crude oil is used in the manufacturing process of many other products as well. Fertilizer prices, just in time for the U.S. planting season, are spiking due to the significant supply shutoff as a result of the Strait of Hormuz closure. There are also ongoing supply chain disruptions in Asia as manufacturers are forced to cut back on production or shut down production in some cases due to a lack of adequate supplies of crude oil and or liquefied natural gas, LNG. About 20% of the LNG production from Qatar, a major supplier, worldwide supplier, will be down 3 to 5 years due to missile strikes by Iran. The LNG supply cannot be easily replaced within that time frame. Iran struck the Qatar LNG production sites after Israel hit a gas field in Iran. I did not discuss how the war is impacting in that prior video the U.S. interest rates, another important consideration across the maturity spectrum. On February 27, 2026, the 10-year Treasury yield was at 3.96% and closed yesterday, March 20th, at 4.39%, up over 10 basis points in the day. The reason for that 43-point spike in the yield, or 10.86% in less than 1 month, is the Iran war and its impact on inflation. Another long-term negative is the amount of debt that needs to be financed and refinanced, with the U.S. government debt surpassing recently, this past week, $39 trillion, with the CBO estimating a $1.9 trillion deficit for the fiscal year ending September 30, 2026, the full fiscal year of Trump's second term. The reason I'm raising that issue is that the amount of debt that the Treasury will need to issue will have an impact on the amount of interest the Treasury will have to pay over time. The appetite for U.S. government debt by foreign governments and institutions are likely to decline, and I've seen this already in some of the numbers, in the coming years for a variety of reasons, including the current U.S. government's hostility to and threats directed at them, which are constant. U.S. interest costs will exceed $1 trillion this year. The entire debt of the United States in 1981 was less than $1 trillion. The amount of interest cost over $1 trillion in 2026 fiscal year will depend in part on the duration and magnitude of the interest rate increases on new Treasury debt. The U.S. will need to issue new debt to pay off maturing debt, to finance the budget deficits, and to pay interest to the U.S. importers on the amount that was illegally collected from them by the Trump tariffs, held to be illegal by the Supreme Court of the United States. And that will be a substantial number, particularly since the Trump administration is slow walking the refund process. The 15-year mortgage rate is starting to move up with the 10-year Treasury and has risen about 10 to 11 basis points since the start of the war. The data can be found at the Freddie Mac website. Click the Research and Perspective tab and then click under Mortgage Rates to link to Primary Mortgage Market Survey. You can also download mortgage rates since 1971 at that page. When I built my house in 1982, the 15-year mortgage rate was over 16% with points added to that. I used cash to build my home back then, primarily a source from interest income, received at 14 to 16% rates in the late 1970s and early 1980s on my savings that I had accumulated up to that time. The 30-year treasury bond went over 15% in 1981. I am anticipating mortgage rates to rise in tandem with increases in the 10-year treasury yield, but not by as much. So that will be another impact on the U.S. economy that is directly connected to the Iran war. The spike in interest rates, which is significant on a percentage basis since the war started, is contributing also to the stock market's decline. For those who follow my blog, you already know that I'm primarily an income investor now, having transitioned many years ago from a pure stock investor who owned no bonds. About 92% of my portfolio now held in my brokerage accounts, and I have 4 of them, is invested in treasury bills and notes, primarily treasury bills, Tennessee municipal bonds, mostly short-term investment-grade corporate bonds maturing within 4 years with some later, and treasury money market funds, a significant allocation of cash for me, and a few CDs that are in the process of maturing, and I'm not buying any new ones because of the low interest rates. The weighted duration of this portfolio invested in income securities is generally in the 2 to 3 year range, and I've recently moved closer to 2 years after selling 122 corporate bonds maturing in 2032 or later. So the bond ladder is short term with multiple maturities each week, so I want interest rates to go higher given my short duration, the constant flow of receipts from maturing securities, the lack of any debt, and my relatively low stock allocation. I mentioned in a comment to my last blog that I have started to buy investment-grade corporate bonds last week as yields had risen enough to make them less unattractive to me, but attractive enough compared to money market and T-bill yields for me to start using some proceeds from maturing corporate bonds to buy new ones. I will be buying 20 of the 6-month Treasury bill that will be auctioned on Monday, and I bought 20 of the 4-month Treasury bill last Wednesday. The investment rate on this upcoming 6-month bill auction may be around 3.75% or even higher. 3.75 is the top of the current federal funds range of 3.5 to 3.75. A 3.75% yield on the 6-month Treasury bill would be consistent with an investor expectation of no Fed rate cuts on or before the September 2026 meeting, and that is due to the worsening inflation picture. It would be a mistake for the Fed to cut rates with inflation moving higher from current levels. A movement above 3.75% and that 6-month Treasury bill auctioned on next Monday would reflect a very tiny possibility of a 25 basis point hike in the federal funds rate in September, in my opinion. So all of these are impacts from the Iranian war and can be directly tied to the war.